Nothing is certain but death and taxes. We've all heard the saying, but it brings up a really good question. What if you want to reduce the amount of tax you're going to pay over your entire life? Do you A, find yourself at investment property and negatively gear it? B, find yourself a dodgy accountant? C, invest in llamas? Or D, make sure you're using the correct tax zone? The answer, of course, is D. In this video, I'm going to talk about the 4 tax zones that we use in Australia: 45%, 30%, 15%, and 0%. Yes, that's right, there's a 0% tax zone. So we're going to talk about what those zones are, how and when you can use them. Here's the usual general advice and accuracy warning. So as always, this is general advice and not personal advice, but specifically, we do not recommend investing in llamas. So what do I mean by tax zones? This is not an official term. It's a term that I use to help visualize and explain different tax environments to clients. I find the best way to explain it is through an example. Let's say an individual or an investment generates $100,000 in income per year. That's what we call the gross income. Then we subtract your deductions, which gives us your taxable income. In this case, it's $95,000. But how much tax you pay on the taxable income, it all depends on what tax zone you're in, where the income was generated. The most common tax zone that you would have heard of before is your individual tax rate, or you might have heard of your marginal tax rate. And this is where the more you earn, the more the government charges you in tax. And they've got different thresholds. I'm sure you've seen this chart before. Some examples there is between $90,000 and up, you're paying 37%, or over $180,000, you're paying 45%. Don't forget that on top of these figures, you also have to pay your Medicare levy of 2% and potentially also your Medicare levy surcharge. A common misconception that I hear a lot is that people think that once you've gone over a certain bracket, whether it's $90,000 or $180,000, that then means your entire income is taxed at a higher amount. It's just not the case. You're only charged those extra amounts over and above that threshold. If you look at something specific like $100,000, if you're earning that this year, which is 2019, 2020, the ATO will charge you $24,497 in tax, so about 25%. So when considering tax zones and all this kind of stuff, it is really good to work out what's your actual net tax that you're paying, not your tax bracket. Best way to find this out quick and easy is jump on paycalculator.com.au, chuck in your gross income in there, and that'll let you know what is your actual tax income and some of the other breakdowns. The next tax zone is the corporate tax zone, or business tax rate. Family trusts with a corporate trustee, they're all going to pay up to 30% in tax. Why am I saying up to? Well, if a business earns less than $50 million, they've got a lower tax rate of 27.5%. And good news for small businesses is that they are reducing this. So hopefully by 21/22, you'll be down to 25%. Next is superannuation in accumulation phase. And I'm sure you're asking, hey, what does that mean? While we're working and while we're getting superannuation from our employers and while we're contributing to superannuation, our super stays in a category called your accumulation account. A better way to think of it is call it your in bucket for superannuation. As your employer or as you contribute to super, it goes into super and the tax rate here is 15%. Money goes in, it's charged 15%. If your superannuation makes income, it's charged at 15%. And the last tax zone is superannuation in pension phase. So any investments in this area, 0% in tax. Any income paid out, 0% in tax. Now, if you've been watching this video waiting to find out what the 0% tax rate is, and as soon as you heard super, you thought, I'm not retired, this can't help me, bear with me for just a couple more minutes. If you're between 25 and 35, yes, you're a bit off retirement. However, 9 out of 10 clients that I meet who are aged 55, 60, the same age as your parents, they don't know this stuff. So forward it to them. If you're between 35 and 55, Knowing this information is important when you're making investment decisions. So, what is superannuation in pension phase? The best way to think about it is, as we're working and as we're adding money to superannuation, it sits in accumulation phase. Then, when we retire, that money gets rolled over into pension phase, and that's when we draw an income from it. And that's why I call accumulation the in bucket and the pension phase the out bucket. A common question is, when can you start using this 0% bucket? Generally speaking, you need to either reach your preservation age, so as you can see here, depending on your date of birth, but primarily we just use from age of 60 and onwards. Here is why this information is important. This is Barry. Barry is 65 and about to retire. He has a few investment properties and some shares, which is going to generate him $100,000 per year in income. He owns these assets in his personal name, and he was self-employed, so he didn't add anything to superannuation. This is Sally. Sally is also 65, also about to retire, and coincidentally has the exact same assets as Barry, except half of her investments are in her personal name and the other half of her investments are inside super. Based on today's tax rules, Barry would pay about $25,000 each year in tax, whereas Sally would pay $7,500 each year in tax. They both live a happy Lego life until the age of 80 where they pass away. Barry would have spent $262,000 more in tax than Sally. Every year in retirement, Sally went on a $15,000 holiday every single year and was still better off than Barry. Bad luck, Barry. The main points of this video are: be aware of the 4 tax zones. When you're making financial decisions, buying or selling investments, just consider it. If you are a little bit older, maybe you're 60 or coming close to 60 or know somebody who is, they need to consider the pension phase and also a strategy called transition to retirement, which I'll talk about in another video. But if you want to know now, just Google transition to retirement. I also haven't spoken about capital gains tax, which is slightly different rates and rules. I'll put a link down below in this video where I've created another little video about capital gains tax, CGT. If you like this video, chances are your friends and family will do. So please share, like, subscribe, etc. And we'll see you again soon.